see the sun, I'm rising up, I feel the love now. Oh, it's in my vision. You know I ran around and I got lost, but now I found you. Well, I can't shake this feeling. Oh, it's gonna take me a little while just to get my head around this moment. But I can see the sun, I'm rising up, I feel the love now. Oh, it's in my vision. And it's telling me run, 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 run. Run, 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 and don't give up. And it's telling me run, 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 run. Run, 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 and don't give up.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the daily NASDAQ stock update for October the 1st, the first day of the new quarter. We have a lot of really good information to talk to you about today. Kind of a crazy day, but you know, that goes along with everything else. The internet doesn't work sometimes it does, but we're here. That's awesome. Okay, great. So we're going to talk about two really good companies today. And we want to talk about how the coronavirus has affected these companies and perhaps what the potential is going forward. And remember, when we're looking at stocks, what we're looking at doing is we're trying to help you to pick stocks that are going to be the long term. This is not day trading. This is not swing trading. This is going to be long-term investing. And really what we're looking to do is we're looking to identify three things with stocks. We want to make sure that they have good earnings. We want to make sure that they have stability. We want to make sure that they have competitiveness. If you can get those three things out of a stock, out of a company, then you have a lot of good potential moving forward from that standpoint. Hey, I want to bring up at the very beginning two different things as we get into this too. One is if you need help with your retirement plan or with your investments, even if they're not stocks, if they're mutual funds or you have a retirement plan at work, and you need somebody that's qualified to talk to, give me a call. Go on my website to richardsfinancialplanning.com. If you go to the schedule a call to learn more button, you can find a time that you and I can get it 20 minutes together. There's no charge for it. And you and I can get together over the telephone, over Zoom, however you prefer, and talk about your particular situation. You can set up a time right there. The other thing that I want to talk to you about today is going to be the different stocks that we have, as we're going to get into it and talk about how these are going to be going forward. So let's get right to it and see what we have today. Let me make this just a little bit bigger for everybody's eyes so that they can see how things are going to be working. Okay, the first stock that we're going to talk about is Starbucks. Starbucks, okay, I'm guilty. Here it is, okay? As you can see, get it in front of the microphone so people can see it. Yes, I have Starbucks on a regular basis. It's probably one of my few vices. Starbucks, and I'll admit I like Peet's coffee too and Nespresso. But anyhow, the idea is Starbucks is a very popular brand. It's tremendous record, and we're going to talk about that record just a little bit. They ended up the day up almost 1%. The NASDAQ itself was up about 1.42, I believe, something around that range. All the indexes were up just a little bit, which is a good way to kick off the quarter. So let's take a look and see what's happening with Starbucks. If you look at the graph, it's a little scary because if we look at it from the standpoint of what happened a year ago, they were at $84.70, about 74 cents. And if you look at it today, it's 86.74. If you see where the dancing cursor is, yeah, that's where the coronavirus pandemic crash hit. And they had a really difficult time and have had a difficult time until recently when some of the stores are starting to reopen. And what's really happening here is their business model is changing. It's not really a place that you go and sit down like a regular coffee shop like you see on Fraser, where you kick back and you're going to drink coffee a long time. They've gotten into a different business model, which is really big. over the year, it's only gained about 2.36%. That's probably something that you wouldn't want to say is going to be guaranteed to continue. But I think it's worth looking at what has happened over the past 10 years in this stock. If you look down at the bottom of this spaghetti graph, you see the D. It has paid dividends every single quarter for the past 10 years. And we're going to talk about that today just a little bit with dividends, because the dividends, the board of directors for Starbucks met yesterday, it was, and they declared another dividend increase. They've increased their dividends actually every single year for the past 10 years. There was a time period you can see here, about 4 or 5 years ago, where they were kind of stagnated, but they've gone on and continued to do well. If you look at 10 years ago, if you'd have had the wisdom to buy this stock at $10.99 a share, it would be worth $86.74. So what kind of return is that over 10 years on your money? Well, if you look at the big number, 10 to 86 is going to be a 688.98% increase. So what's that mean in APR, annual percentage rates? Wow, 22.94% APR. This company has a really good history from that standpoint. Now, look, I have to tell you, just like every other stock and every other investment, that the past performance is not going to be a guarantee of what's going to be continuing on into the future. But we have to look at the earnings and figure out what's been going with the earnings too, and how things are working. As I do every day, let's remember that the solid line is actual earnings that were paid. The dotted lines are the estimates. Estimates are really big on Wall Street, because when a company comes out and it doesn't meet its estimates, then it's not a good thing. Generally speaking, though, Starbucks has exceeded its estimates every single quarter. They've been a money-making machine over the past years. Now, okay, so we look at Q3, sales were off considerably, but, there was this thing called the coronavirus pandemic, and it caused a big problem. Just imagine 10 or 20 years from now, people will be sitting around sipping their Starbucks going, wow, do you remember what it was like back in, 2020? We couldn't even go into a Starbucks. We had to go through the drive-through, where we had to get the Keurig itself and use it. But anyhow, I digress. They have a very good earnings history. That's the point that I want to look at. Now, what happened yesterday was the board of directors met, and they said, we're going to go ahead, and we have a lot of confidence in our company going forward, and we're going to declare a dividend increase. So they went from 41 cents to 45 cents a share. That's about a 10% increase. And that's the same thing that it's continued to do. Adjusted for, they had a stock split back in 2015. I don't see that on the horizon for a while, but they had, prior to this, a 1.91% dividend. When we look at what happened with the increase that happened yesterday, it's not 1.91% anymore. It's actually a 2.1% dividend. So that's really pretty good for a food company. And when we look at it, one more thing I have to tell you about. Please, when you look at this stock, don't go into it from the idea that you're going to buy the dividends, because I think that you'll be disappointed. Because look, this is technically what ends up happening. If you have a 45-cent dividend or whatever that's going to be from this standpoint, and if the dividend is declared, yes, it's already been declared, and there'll be a pay date and the next date. But the idea is going to be, if you buy into it, you're not going to be making any profit over top of what's there. If you buy into a share and it's $86 a share and it pays a 40-cent dividend, let's say, just for the math purposes to make it simple, it's going to go from 86 down now to $85.60 mathematically, if before trading or anything else goes on like that. It's basically a reduction in price. There is no benefit to buying a stock when the dividend is declared. It's called buying dividends. And actually, stockbrokers and representatives, they're prohibited from telling people to do that. It's called buying dividend. That's a no-no. But the idea is that it is good for the long term, but don't buy the dividend and expect that it's going to really increase anything. Actually, all it's going to do is it's going to give you a taxable income, because remember that if you buy this stock now, you get a dividend, you're basically going to be getting your capital returned to you, and you're going to have a taxable income from that standpoint. So don't do that. All right, there's better ways to make money. Let's compare this to the companies that are out there that are similar to it. You might say, hey, what is like Starbucks? You're going to be surprised about some of this. Yes, Starbucks does compete with McDonald's. Of course, McDonald's has a lot of other different things that they sell besides Happy Meals and things like that. But Farmer Brothers is another company that's out there. And Farmer Brothers is a company that actually is a wholesale coffee company that sells coffee to restaurants and whatnot. And you get to see they haven't really done very well because of the coronavirus. Why? Because restaurants are not open and they're not selling very much. So if you follow the dancing cursor, you can see the green line is for Farmer Brothers, and they've done terrible from this standpoint. Over top of that, Starbucks has actually done pretty good, but what's done a little bit better than that is J.M. Smucker. Yes, it's the same Smucker's jelly, but did you know that Smucker's also owns Folgers Coffee, and they also own the Dunkin' Donuts brand coffee, not the donut shop, but the brand of coffee. And they've done a little bit better than Starbucks, but they're right in there. So when we look at companies from the standpoint of the spaghetti graph, like you see in front of you, what I'm trying to do is to point out to you how it competes. And they compete very well. They excel over top of some of their competitors. When you look at the size of the company itself, the company I mentioned, Farmer Brothers, is extremely small. It's a small cap company when we look at a comparison from that standpoint. As far as dividends go, there are a lot of food companies that pay dividends. When we look at Smucker's and McDonald's and Starbucks, they're all paying dividends. And I really think part of it, Starbucks might have said, yeah, we're going to give this because we have confidence in our company. Yes, they do. But to compete, if you look at it with McDonald's at a 2.28% dividend and Smucker's with a 3.06% dividend, if you want to compete, you're going to have to pay dividends. But remember, the past performance of these companies is not the future results. Starbucks is a wide moat company, and I made actually 2 pages on this because I really want to emphasize this. This sets them apart from some of their competitors. And one of the biggest things that they have going for it is, hey, you can drive up to Starbucks and get your coffee. You can do a mobile order and a mobile platform. That's a big deal too. They have their K-Cups. Yep, here they are right there. They're K-Cups. K-Cups are a big deal. Nespresso. If you haven't tried Nespresso, it's really a good thing. I love it. They have delivery partnerships too with Alibaba, LME, and Uber Eats, and other different delivery services, DoorDash, etc. And they also have complementary brands. Can't say that. Complementary brands. Tivana and Princey. If you've never had Tivana teas at Starbucks, they're really pretty good. Another thing that gives them a wide moat. Hey, remember though, what is a moat? What's a moat? Other than telling you what a moat is, that gave me a great chance for a sip of my Starbucks. But the idea is the moat is that imaginary barrier that's between the company and their competition. Okay. So when we look at what sets them apart, I've given you all the other reasons. And when the last one is, it's a really big deal, is that Starbucks is really invested into its employees, and they have an employee investment program. I'm not sure the exact details, but I know that they do help their employees with college education and a lot of other perks that goes along with from that standpoint. So that gives them a wide moat. Okay, let's look at it and see what Morningstar is saying about Starbucks. Remember, Morningstar gives the star rating service. Remember, the star rating is not like a restaurant rating. It's going to be based on value. They're saying that the fair market value of Starbucks is $90 per share. Right now, the current value is $86.74. So what's that mean? That means that this stock according to Morningstar, is trading at a little bit of a discount. Remember that the earnings per share is the way that they derive the fair market value. And generally what they're going to do is they're going to take the earnings per share. They might take EBITDA, which is going to be earnings and taxes and interest and all that kind of good stuff that's built into it. They may take the earnings per share, the complicated calculation there, and they're going to take it as a multiple. They might take it as 10 to 15, whatever the case is going to be. But they're just not pulling it out of the air and saying, hey, I think that it's worth $90. That's not the way it works. Okay, but it's a little bit undervalued right now, so they're going to call it 3 stars. I call this a GARP stock. GARP is going to be growth at a reasonable price. I think it's actually reasonably priced right now. So let's see. Oh, I missed one. This is not Regeneron. This is yesterday. The name on the top of the screen is wrong. It should say Starbucks, but this is truly the Starbucks analyst information. There were 22 analysts that were reporting. 10 of them said that it was going to be a strong buy, and 11 of them said a hold. One of them said it was moderate. So when you average all that out, it comes out to be a moderate buy. So, you know, when we figure it from that standpoint, and please don't hold me to this. I made an error. Regeneron was yesterday. This should stay Starbucks. All right. Not my buy or sell recommendation, just reporting to you what the analysts say. All right. Next one company up is going to be Ross Stores. Ross Stores is really, they've been hurt by the pandemic by a lot of other companies, but you're going to see that Ross is not in the same boat as like JCPenney. Ross is a retailer, but there's going to be companies like Ross and TJ Maxx that are actually, they're coming out of this making some profits from that standpoint. Today, they ended up 1.62%. It's a big company, big company. $33.8 billion in market capitalization. Let's see what happened from last year. Last year, this time, they were having a great old time and thinking that life was wonderful, as most of us did. $108.72 per share. It is at $94.83 today. Yes, it was up about 1.5%, but the point's going to be that it is still down 12.48%. Don't run for the woods yet, folks, because this is really important to understand that when we talk about stocks in this show, we're talking about stocks for the long run. We're not talking about stocks for day trading. We're talking about stocks that are going to be able to be there for a long time. Now, remember, when we talk about stocks for retirement planning, there are 3 instances that people need stocks for retirement planning. One is going to be diversification. There's a lot of reasons for that. Long story short is you don't want to put all your money in real estate or gold or silver, whatever the case is going to be, even cash, because cash actually goes down in value because of inflation. Yes, goes down because of inflation. So diversification is one of the reasons that people buy stocks for retirement. The second reason that people buy stocks for retirement is going to be growth. If you go back and you look at my website, you're going to find a blog on different types of strategies for taking money out of retirement. There's one that's called the bucketing system. And what the bucketing system does is it segregates different time periods. And I generally use 3 different time periods. I'm going to use 1 to 10 years, 10 to 20 years, and 20 to 30. When we look at stocks for growth, it's going to be for that 10 to 30 year time period, not 1 to 10, that 10 to 30 year time period. And we set it up so that it can grow and continue. All right. Now, what's the third reason? The third reason that people buy stocks is because of dividends. Now, you're going to find out that Ross Stores does not pay a dividend. But when we go back and we think about Starbucks and other companies like that, they do. Actually, about 60% of the companies that are listed in the NASDAQ 100 do pay dividends. And that's a good way for you to create an income stream, is to have a diversified portfolio. Now, they're not guaranteed. It will fluctuate to some degree, but it's going to be better than some of the fixed interest rates that are out there, although you don't have the guarantees that a fixed interest rate. Okay, so let's keep moving on from this standpoint. And I think it's really worth looking at how this stock has done in, it says past performance, no guarantee future results. We hope so. All right. How has Ross Stores done over the past 5 years? I think that's worth looking at because remember, we're not buying a stock for a day, a month, a year. We're buying it for 5 years from now, 6 years from now, because you have to understand that when you buy stocks, this is an important part of growth. The average bear market is that the average recession, average bear market is going to last about 18 months. The average bull market is going to last about 3 to 4 years. When you add that together, you're going to find out that the average market cycle, the total market cycle, is about 5 years. So you need to think of you're investing at least for growth, at least in 5 to 10 year time periods, at least, perhaps longer. When we look at what the value was 5 years ago, was $46.60 a share. As we've talked today, it ended at $94.83, and really, it's 103.5%. Yeah, it's not the great big whopping return that we saw from Starbucks a little bit ago, but in total, that's a 15.7% APR. That's not bad for a retailer. And look, people are going to need clothes. That's just the way that it goes. They might not be needing them as much now because, hey, everybody needs a Zoom shirt, let's say. But as we get our economy back, as the coronavirus, we find a vaccine for it, and we find ways to combat it, people are going to get back to work. And you're going to find that the shares that are depressed right now in companies like this that are hanging on are going to be well worth hanging on to. All right. As we say always, though, no guarantees. Past performance is no guarantee of future results. Of course, no dividends. But let's keep going on. And let's talk about the earnings, because I think that if you look at the earnings, that's a real big thing to consider from that standpoint. Let's make it just a little bit bigger. So you understand, if you follow me just a little bit, you understand what's going on with the dividends. You know that the solid line is going to be actually what's paid. And we know that the dotted line is going to be the estimates. And generally speaking, the management of Ross is excellent. They have a unique business model, and they've done extremely well. Yes, they did tank during the coronavirus pandemic. People just weren't buying clothes, were buying toilet paper, buying things like that, the things that they needed to survive. But now that we've come out of our bunkers and our shells, we're really starting to get back, and we're buying different things. However, there are a lot of people out there that are still hurting financially. And that's one of the biggest reasons why companies like Ross are actually doing very well. When we look at Ross Stores, I want to compare it to other companies too. When you look at the blue line, follow the dancing cursor, you can see where Ross is at. Okay. What is this company that's in gray? We're going to find out in just a minute. But say Dillard's too is another company. If you're in Texas, Dillard's is something that we all know about. A lot of northern areas don't. Dillard's is really considered a small cap company compared to some of the companies like Ross. When we look at Macy's, it's interesting. Macy's is actually a shell of what it used to be. It's actually considered a small cap company now. It's around $1 billion is a small cap company, but it's still, it's not as large as it used to be. And if you look at the green line, it is hurting. They're hurting from that standpoint. They're a premium retailer. Premium retailers are hurting. They're giving up a lot of their businesses because there's people, if you're out of work, but you need something for your kids, you need you need socks for your baby, you need pants for your children, you need a shirt for yourself, you need something like that. You're going to go to a discount store if you're not rolling in money, which most people are not. So companies like Ross Dress for Less, that's their motto. You're going to find that companies like that do much better right now. And in the long run too, Nordstrom is another company that's out there that's kind of hurting as well. But the other company that competes really, really well with Ross stores is TJX. TJX is the TJ Maxx stores. They have a similar business model. They actually have more stores than Ross does, but Ross has a different model. Let's talk about some of the competitiveness that Ross has going for it. For a retailer, there are some retailers out there that don't have a moat at all. They have no barrier between them and their competitors. But Ross really does, because they have an off-price business model that works really well. They have excellent relationships with their vendors, and they have thousands of vendors, and they have a very, very strong inventory management system. If they have a brand name that they go to, they might not be touting that they're selling a brand name, but they may be selling it for less in their stores. And that's really where the relationship comes. They have 900 buyers thereabouts, and they have relationships with around 7,500 different vendors. That's the off-price business model, and that's the big advantage that's going on right now with Ross in itself. And that's one of the reasons why they actually have a very good future, I believe, going forward. Morningstar's estimates on this company are interesting, because they're actually saying the fair market value is a little bit underneath what they're trading at right now. It's trading, according to Morningstar, 7.76% premium. They actually give it 3 stars. I still call that a GARP stock, or growth at a reasonable price. When we look at, hey, look, I got the right name in there. All right, good for me. Give me a gold star. All right, when we look at what the analysts said, when we go to 20 different analysts, the analysts, 15 of them are saying that it is going to be a strong buy. 4 of them are going to say that it's a hold. And really, that kind of outweighs everything. When we look at the average, it's actually a strong buy, according to analysts that are out there. So as we go through all this different information that's available, I want you to keep this in mind. Remember, this is not my buy-sell recommendation. I'm just reporting to you what the analysts say. And I want to remind you that if you need help with your retirement plan, if you need help with your investments, if you need some advice in what direction to take, give me a call. Set up a time so that we can have a chance to have a conversation. Go to my website, which is right here. Go to the schedule a call to learn more button that you'll see right here, and a calendar will come up. You can find a 20-minute time slot, and then I'll give you a call and we can have a conversation. If we need to do a Zoom call so I can see actually documents that you have to talk about them, I can do that too. But a lot of times we talk about all the different stocks that are here, and I may talk about them as that this is a good stock, this is a good stock, this is a good stock. I'm not trying to give you advice to go out and buy one stock over another in per se. My idea is that you need to build up a strategy towards accumulating money towards retirement, or what other goals that you have that are out there. I wrote a blog recently that's called How to Invest $1 Million in the Stock Market. And I go into more detail on the type of strategy that I utilize. If you actually go to my website, take a little time, go down all the way to the bottom of the page. I call that the junk drawer. Actually, that's not my name for it. That comes from Donald Miller of Business Made Simple. If you go all the way down to the junk drawer, that's all the information down at the very bottom of the website. You're going to find blog. Click on that blog and look at some of the information that's in there, because I've written thousands of words that I think are good pieces of information, good complete pieces of information that even if you and I don't get a chance to talk about your retirement plan or your investment strategies, I want to share my knowledge with you. I can help you to learn more about how to save money toward the future. I can teach you how to budget. I can teach you how to arrange your investments so that they do what I said at the very beginning of the show, that they last you for your entire retirement and you don't run out of money for your entire retirement. So with all that said, I have a disclosure which is coming up, and thanks for joining us today, and come back tomorrow. If you just jumped in, hit the replay button and you can replay everything. If you come up with questions, I've got something new that's coming up too. So make sure that you hit the subscribe button because I've got some new information coming up. Hit the subscribe button and you'll see what it is. So until tomorrow, hey, tomorrow's Friday. Thank God. All right. That sounds great. We've had a great week. Have a good evening. Talk to you tomorrow.